remains spooked, but it may not be this one, since the finance minister has said no, there won't be a capital gains tax. Let's get the tax experts to parse these two statements and more. Ketan Dalal, senior tax partner at PWC, and Bobby Parikh, chief mentor at BMR Advisors, have joined us. Good afternoon to both of you, gentlemen. Mr. Dalal, what is your interpretation? No capital gains, would you take that at face value? And if not, then what did the Prime Minister mean? Should we expect other taxes?
Yeah, so Lata, I think as the finance minister has clarified, one would obviously go by the absolutely clear reference of what the FM said, that there is no intent to levy capital gains. But equally, yes, you are right, there was a reference which was worrying in the Prime Minister's speech. So one possibility could be the dividend tax, which is 10% currently, in addition to the DDT. I don't know whether there is any move to equalize, because remember, if there is a DDT of 22% and the tax over 10 lakhs is 10%, it is still a few percentage lower than the maximum. The difference is not much, but there could be a possibility of that. Maybe there will be a change in dividend taxation. Maybe it goes back to the withholding. I'm not sure, but clearly there was some reference which has obviously got. And I'm not a market person, but it has got, obviously, the market a little spooked. Okay. Could there be, Mr.
Parikh, any other ways of taxing that the government is looking at? Basically, how do you pass both these sentences?
Lata, I don't know. There aren't so many different taxes that can apply to the capital markets. There's a securities transaction tax, which is what it is, and it's I don't know whether they want to increase that. As Ketan said, I don't know whether they want to increase the tax and balance the tax on dividends. But that, to me, I mean, for that to find a way into the Prime Minister's speech sounds really not so material if it's only a small percentage, small movement in taxes that will apply. So I don't know. I mean, I can't reconcile the two statements.
Okay. Bobby, hi, good afternoon. The other issue I wanted to discuss with you was the IT department clarifications that came out last Thursday on the indirect transfer provision. So basically, the possibility that investors who have invested in offshore funds, who have more than a 5% holding, will be additionally taxed 20% short-term and 40% long-term. Are we right in reading it like that? And would that be a big concern?
I think that could be a concern, because that is the way that the clarification reads. Much of the clarification is sort of the illustrations that the CBDT clarification contains, for the most part, apply to foreign portfolio investors and FPIs. And the clarification seems to suggest that if there is a transfer or a redemption of units at the fund level, and if the investor, the holding of the investor exceeds the amount that is exempt from tax in India, then a tax would apply. So this actually is something which technically, since the amendment was made, was an area of exposure potentially, because of the amendment was made in 2012. The clarification has come now.
So what is the tax rate that would apply? I mean, what is the prevailing tax rate of both short-term and long-term that would apply to these offshore fund investors?
So now that also is a question mark in terms of whether there are rates which apply to investments made by foreign portfolio investors in Indian securities, and that's the rate which is contained in the Income Tax Act specifically for foreign portfolio investors.
Which is?
But those, so it's zero for long-term capital gains, exchange traded shares long-term, and 15% if it's short-term.
Okay.
Now, however, those rates apply only in relation to securities, Indian securities, which are sold on the stock exchange. Now, will the same rate apply to units of the offshore fund which are traded by those investors, or will regular rates apply to them, is something which is not clear right now.
Okay, actually, Mr. Dalal, your take on the same issue that Sonia raised. Will it apply to private equity funds? Will it apply to offshore funds which have put all their India dedicated exposures into one sub fund? And then the offshore fund obviously has more than, it has 100% ownership, or maybe definitely over 50% ownership of the sub fund, and therefore becomes liable. Which are all the cases that one should worry about?
Okay, so there are three separate points, Lata, I want to make here. If we just step back and look at the bigger picture, this entire controversy of what they call transfer at an offshore level, or what they call indirect transfer,
Yes.
arose as a result of the Vodafone thing. And that was more for, I don't think it was ever meant to apply to portfolio investment in the first place.
Yeah.
So in that sense, there were lots of representations to say, look, this was never intended to apply. The impression we all got, and I'm sure Bobby will probably endorse what I'm saying, was that while the 5% threshold was made in 2015, the general impression was that even the government was receptive to the fact that this was never supposed to apply to portfolio. So it's very unfortunate. Now, I think what has happened
But the CBDT circular is very, very clear.
Absolutely. I agree with you. See, I'll tell you what is happening. The CBDT circular is what I would call in response mode, as opposed to as opposed to listening to recommendation mode. So it's like saying, here is a law, and this is what the position under the law is. Yes, that's true. But the point is that it still doesn't mean that the government will not amend it, because I honestly don't think it was ever supposed to make or be relevant to portfolio. Look at the reverse. Suppose we invest here in a US opportunities fund, say Franklin US opportunities fund. I don't think that when I redeem that, I'm actually even thinking of US tax.
Yes.
So if we think of the reciprocal situation, the extreme nature of this taxation is perhaps becoming more obvious, and therefore I think it needs to be addressed honestly.
Oh yes, in fact, Bobby, come in on this. If I'm right, most of these big investors, like the endowment funds and the sovereign funds, are tax exempt in their own country, right? So they will not get any tax offset for the ones for the taxes that they're going to be paying in India if this comes through. So in effect, what this means is all of these taxes will come out of their own returns.
So that was always the case in any case. I mean, so in the sense that other than sovereign funds which were investing from jurisdictions which have favorable tax treaties, which really, I guess, is Singapore, the other sovereign funds would have paid tax on the transactions that they had on the Indian stock exchange. Now, unlike a situation which other funds would have, sovereign funds don't have other investors. So I don't know how the sovereign funds distribute back to the sovereign itself, and whether there is an indirect transfer kind of situation that would arise in the context of sovereign funds. But it would arise in the certainly in the context of other vehicles which are organized as funds and which have multiple investors. And I mean, two things can happen there. One is that the way that the investors exit the fund is by redeeming their units in the fund, or the other is by transferring their units on a stock exchange if the fund is listed on a stock exchange. Now, both of those, if the fund is substantially invested in India, both those are regarded as transfers. The redemption as well as the transfer on the exchange will both be regarded as transfers under Indian tax laws. And because the fund derives its value substantially from assets in India, it technically triggers the indirect transfer provisions. And that is what, as Ketan said, that is what the circular now clarifies. Whether that was ever intended or not, whether indirect transfer provisions were ever intended is a separate issue, but that is how they have clarified it now.
Exactly. So, will it, I don't know, I didn't get through to all those 8 question and answers, but will it be retrospectively applied? If it is prospectively applied, will we see a flurry of selling or only a flurry of reconstituting of subsidiary and principal relationships?
So at least my read of the circular, I can't, and Ketan can step in maybe, but I can't remember if there is anything in it which clarifies that this is only prospective.
Oh,
okay.
Oh God.
So there is a chance, Mr. Dalal, that this could be retrospective in nature as well? Mr. Dalal, is my voice reaching you?
Okay, I think we'll reconnect with Mr. Dalal. Mr. Parikh, I also wanted to ask you, because the Prime Minister has spoken about market guys benefiting from the market needing to contribute, do you think there can be any further tightening or more stricter interpretation of the Mauritius double tax avoidance treaty as well? Were there some leeways that people could have used, which will now get more strictly applied? And, earlier today, Kanabar was also speaking about the very word anti-avoidance and whether that can be used even for, things like dividend stripping. Nothing to do with foreigners, but general anti-avoidance even within India.
Yeah, so I mean, we already have dividend stripping provisions in the income tax law.
Okay.
So it's not as if those provisions don't exist now. Whether they want to tighten those, they have been there. They've been tightened in bits and pieces as the revenue have discovered arrangements which they believe are abusive in any fashion. So there are provisions which apply. I mean, there is bonus stripping. I think is less. I don't think there's an explicit provision on that, but dividend stripping there is a provision. Maybe you raise the bar on that some more so that it becomes even more difficult for anyone to sort of take advantage of those kinds of transaction structures. As far as Mauritius treaty is concerned, I think it's just been modified. It's just been the modification has been notified. So I don't know that there is anything more to be done with that. And between what's been done in the tax treaty and the GAR when it comes in with effect from next year, I don't see that there is a whole lot of room left for
further tightening,
for any abusive planning.
But there's no clarification on the GAR issue as well, right? I mean, is that something that would cause a bit of chaos? We were expecting to get the final clarifications before the April 1st deadline. Would that be a cause of concern?
I mean, it is. I think that for a change which is as significant as GAR, I think we should have had clarifications a while ago, but we haven't yet received them. And so we are now getting into January, and that gives only 2-3 months before the new provisions kick in. So, I mean, I would think that is not enough notice, and ideally it should have come sooner. And there is an issue under GAR. I mean, one of the issues that has been sort of in discussion for a while is whether the general anti-avoidance rule would override specific provisions that are contained in the tax treaty. And so whether if the Mauritius treaty as it is now amended contains some limitation of benefit clauses, then is that, so long as you fulfill those, does that mean that treaty relief is available then and GAR will not apply? Or is GAR meant to sort of apply on top of all of the specific limitations that the tax treaties may contain?
Okay.
That's a fundamental issue, and it's, the Shom committee recommended that where there's a specific anti-abuse regulation, then the general anti-abuse regulations ought not to apply.
Okay.
But that clarification has not been provided.
I agree with you. A lot is awaited, and even a lot can be feared from what has been disclosed in the CBDT circular on indirect transfer of assets, as well as the Prime Minister's general reference that people who benefit from the market must contribute. Enough between these two to worry the markets. Mr. Parikh and Mr. Dalal, if you can listen to us, thank you very much for joining us. And